You quite like emerging markets, which is topical after we see the signing of this Trans-Pacific, or not entirely Trans-Pacific, but certainly parts of Asia-Pacific trade deal, RCEP. What is it that you're looking to buy into in emerging markets at this point?
Well, broadly, emerging market, especially emerging market equities, is our biggest overweight at this juncture. And the reason for that is threefold. Number one, Biden presidency likely to be rather dollar negative, not significantly, but modestly dollar there. And that should be supportive of emerging markets in general, especially on the relative performance versus developed market. And number two, if you look at some of the virus dynamics, we're calling we're looking at China being ahead of the curve, and countries within the sphere of influence around China also doing better in terms of containing virus in comparison with the rest of the world, and that should kind of support sentiment, positive sentiment towards this part of emerging markets. And also when we talk about kind of cyclical global growth upswing, which is what we're heading towards going into 2021, emerging market having a higher gearing should benefit as well. So this is why we are broadly positive and overweight emerging market equities, and within that continue to have a preference for kind of EMEA and countries around kind of sphere of influence around China. And the trade deal announced over the weekend is cementing that conviction as well, that we have two spheres of influence, US and China, and you have to own them both in order to have a diversified portfolio. And a lot of our investors, they are already quite heavily owning US, so the big delta is China.